I'm going to call up the moderator. So Michael Jordan, thank you very much, sir. He, of course, is the business development for Polygon Enterprise. Then Daniel Kimber, co-founder of Bakari AG. Let's hear it. Listen, you've been given hands now. You can clap. Thank you. There we go. Okay, wonderful. Hannes Wessels, who's the country head for Southern Africa at Binance. And then Sebastian Stent, product marketing manager for Web3 at Oprah.com.
Thank you very much.
Awesome. Thanks. Thank you everyone for being here. We're going to be chatting about DeFi risk management with this really awesome panel. But I think maybe we've had a little bit of an introduction, but maybe each of you can give in your own words who you are and maybe how you would define risk. And we'll take the conversation from there. Do you want to start?
Okay. My name is Sebastian. I am product marketing manager for Opera's Web3 products, including Opera Crypto Browser and others. How do I define risk? Well, I've been a DGen since Simon Dingle, who was on earlier, gave me my first Bitcoin paper wallet in like early 2012, 13, something like that. So how do I define risk? I define risk as traditional financial markets and central bank currencies, and the big cliff they've fallen off lately is way more scary for me than anything happens in crypto. So,
okay.
Yeah.
No, like
risk is based on your perspective, and I think we're in a much riskier time than we were 10 years ago. So, yeah.
Perfect. Daniel?
So my name's Daniel. I'm the co-founder of Bakari AG. We're a Swiss company that focuses on DeFi and real-world assets on-chain. Defining risk, I think you're going to be able to go down the rabbit hole with Alice there. There's so many possibilities that could go wrong, and I think it's when looking at investments, you need to see as many possibilities that could go wrong and understanding how you would mitigate those risks. But an actual definition, I think, would be too vague.
Hannes Wessels, I'm the country manager for Binance in Southern Africa. Risk, what can go wrong? How badly can it go wrong? I'm going to stick it to that, but yeah, I have a number, because it's about the number, not some woolly concept, but I have a number, now badly things can go wrong.
And I mean, this is the unfortunate truth of our reality, is that things can go wrong, and they frequently do. And this is why we do have insurance to try and manage risk and that. But now we've introduced this new technology of DeFi, and we're using this in ways to manage risk. So do you guys want to talk about some of the projects that you're most excited about that are managing risk using DeFi?
I think if I can start, maybe just with that broader concept. For me, the DeFi space got those two elements. There's the peer-to-peer element, and I think that's very exciting. It takes us all the way back to the Bitcoin white paper and why this was established. It's about peer-to-peer. And that's one of the things I think South Africa and Africa generally really needs. There's the second element to it where we borrow and lend to and from each other. And I think that's the bit where risk comes in. I think when we simply pay each other, there's already some form of willing buyer, willing seller concept, and that's pretty basic. When we start borrowing and lending from each other, I think that's when we need to be careful. You need to know who you're dealing with. Counterparty risk, liquidity risk, credit risk. So I think as a platform, I'm not going to go into any of the specific products. We obviously do a lot of due diligence on all the good ones, and they should all be on Binance. But yeah, there's a lot of good stuff out there.
Okay, perfect. Daniel?
We operate and advise a DeFi yield fund, so it's very much acting as a liquidity provider and earning yield for our investors. So we won't talk directly about certain products or where we've allocated, but one of the biggest things is simplicity for us. We want to understand what exactly it is, where the money is going, how it's earning yield, and also just making sure that everything we look into is trying to find why shouldn't we allocate. And then when we see why there's no reason not to, that's when we do it. And it's sometimes a bit detrimental to ourselves because there are higher yields elsewhere, but the complex structures and ideas that they have and the lack of transparency of where the money's going from is something that really makes us take a step back and just be more curious about how this works. And I think that's one of the biggest things, especially on DeFi protocols is trying to understand why is there such a high yield that no one else can provide. You're getting yields of 35% where most high-risk asset managers are returning 25%, where yields should be taking no financial down risk, especially with collateralized lending, but you then assume this new technology risk that you need to understand from the smart contract side.
Well, I mean, there's been some of those DeFi products that offer like 1,000% yield, and of course it's so tempting. You stake a little bit of tokens and you're going to get so many more, but of course there is that risk of inflation. You're going to erode the true value of it, and you could actually have a negative yield overall when you convert it back into your own currency.
I think when you look at, I think when you look at certain DeFi protocols that have over-collateralized lending, so especially if you're the liquidity provider, not the borrower, it does, making sure that that smart contract's going to execute, making sure that when certain collateral hits a certain stop loss, that's going to be sold and you're going to be able to get your money back. And DeFi is a great way to be able to go in and out of lending contracts because you suddenly have access all the time, unlike your fixed loan where it's a 5-year fixed interest rate. So that obviously affects your yield, but knowing that your actual finances are safe really does make it great. So it allows you access to your funds, plus as well as earning yield, but with the obvious safeguard of your collateralized.
I mean, I'd say most of the risk that we've seen in DeFi up until now has been the sort of risk of predatory capitalism rather than the risk of the technology that is being used to sort of be predatory and capitalist. And like if you look at those, as you were saying, if you look at those ridiculous yields, those are a clear sign that something's wrong in the system where there's that much sort of capital just flowing over the top of it. So you've got to assess things from a realistic way and look at these things from where the risk is mitigated. So in DeFi, for example, you don't have a central authority, so the risk, some of the risk of, for example, central collapse is mitigated. Sometimes there's more robust mechanisms because of blockchain implementation that prevent some of the threats to your assets that you'd see in a centralized bank that just is too big to fail and then comes crashing down, everyone loses their money. And at the same time, you can look at some ways, like for example, non-custodial wallets, your keys are your own, so those sorts of principles that are very secure. When you look at that versus managing your money in traditional banking, which is not that secure. I mean, the bank takes their chunk and you lose a bunch and then you're left with a little bit at the end. So I would say that like the risk profile is probably the same. It's just now we have technology with money baked into it that there is more risk from hacking when there's money baked into the software you're hacking, or there is more risk, for customer data being more vulnerable if it is financial data that's baked in there. So in all these things, I think it's an iterative landscape. And that's also an exciting thing about it. Like, it's changing as we're changing, and every time there's a hack, there's a software update to make sure that doesn't happen again. I mean, I lost a lot of money in the first DAO hack, a lot of money. And now, if we look at DAOs, they're a fundamental part of the way we organize ourselves in the blockchain Web3 world. So I would say that without those hacks, often we don't learn what we need to do to make the landscape better and more robust for the future.
And I mean, what would you guys say is one of the interesting things about DeFi, like the way it can manage risk that centralized finance was unable to do? So like, what are some extra, tools or techniques that it's able to mitigate something which in the old system we just had to simply retain whether we liked it or not?
I think if you look at the traditional system, it's basically aggregation of funds through deposits in the banking system. And then what the banks do very well is they then have their credit functions who determine where that money goes and who can lend. The advent of smart contracts gives you the ability to determine that between parties without having the intermediary who takes a fair chunk out of it. So the cost is far lower, and the smart contract can be written and done and executed in a way where by the time everything's fulfilled, the funds simply flow. There's no additional bureaucracy. So from a bureaucracy and simplification perspective, so much easier, as long as you understand your counterparty.
And I mean, one of the things I know with risk management is sometimes there's those residual risks. You try, say, insurance, you take out insurance to cover some risk, but now you have counterparty with the insurer. So there's always these residual risks that pop up. What would you say are some of the risks that by implementing DeFi strategies or using the DeFi technology, we're creating these other risks. I know you were mentioning hacking because now the money's baked in, and that becomes a little bit of a honeypot for these hackers to get into. Are there any other risks, residual risks, that DeFi brings up that we need to be aware of when we're using this technology?
Well, yeah, I mean, the last couple of months have given us quite a distinct one with the Luna and Celsius crash. It's turned into the PvP era of crypto sort of, what are they called? Like a, what's it called, where you have like a really predatory attack on a business?
Hedge fund.
Yeah. So it's the peer-to-peer era of that. Like over a weekend, major billionaires have been taking down billion-dollar enterprises just to prove a point. And there's thousands and thousands of people whose livelihoods have been lost in that process. So I think for me right now, the bigger threat is not the marketplace or the hackers. It's actually the billionaires who are coming in and like doing these really aggressive moves to damage large spread confidence within the marketplace and take out big players within it.
I think one of the risks that DeFi brings is also just a personal risk. If you're holding your own, don't have an independent custodian or something like that, if it's not your keys, not your crypto. But it's also the lack of understanding that these certain stable tokens aren't stable, like UST. So when you want to go into certain DeFi protocols, not only do you need to kind of assess the risk and be curious on these yields, but what are you using to actually earn this? You're not putting in straight dollars or rands, you're using things like UST. So what happens when the onboarding ramp goes to zero? So there's almost like a second step now that traditional finance doesn't really have. You know, you give your money to the bank, it's rands or dollars, whatever bank you're with, and it's a fixed reserve bank currency. But now you're not only having to trust these lending protocols, but also trust these issuance of other stable tokens. It's almost like the definition of stable token hasn't been well defined enough to have someone like a Luna that can peg it against their share price, which is volatile. So there's almost like a second step that no one really spoke about before the crash. But that's something that's actually quite exciting about DeFi, is that we're seeing these mistakes now, and certain people wouldn't get into UST because of that and would only use something like a USDC. So that extra step is now suddenly being like, sorry, I nearly swore. It's more like saying that your investment product is one risk, but now the actual onboarding and how you access that investment is also, there's risk there. So it's almost a two-step approach.
So, yeah, maybe just bring all that together. You've got that collateral risk where you've got to make sure your stable coin's backed. That's what happened with Luna. It was an algorithmic coin, and the hedge funds they just wait for that stuff. The moment they see these two bifurcate, they hit it. And there's a lot of liquidity coming in, nothing you can do about it. So the other one is liquidity risk. If you do stake with anybody, make sure you understand the terms. How long are you locked in for? And can they carry you for that period? And the last one is good old credit risk. Who are you dealing with? Do you know who's behind where you're staking? Do you know who they're lending to? And it's really a bit of a bank thing. By the time it's centralized, it becomes a bit of a bank. And you must also see whether they're doing their due diligence on the other side. Like you would, if you do a peer-to-peer transaction, and with a smart contract, you'll do your own due diligence. You'll see who the counterparty is. Can they repay you? Do they have the means? It's just stuff like retained earnings and free cash flow. Can they repay me in 3 months' time?
So, I mean, with all of that kind of said, in the future, do you still see financial institutions playing a very big and significant role in our financial systems? Like to be maybe helping out with custodians, helping out with due diligence, helping out with those kind of things? Or do you think we're going to move to a place where everything is peer-to-peer, there's no more middleman, and everyone's in control of their own keys, their own risk, their own return?
I think we've got two parallel rails for a long time to come. I think, yes, the balance will shift. Let's see which way it shifts. We can't ask that question almost without saying the word CBDC. That still needs to enter the phrase. So I think you're going to have the traditional finance system and then the peer-to-peer DeFi system that we're talking about running in parallel. I think it's just important to see that, and hopefully it comes together as a complete circuit and a closed circuit. Then it works well. If it operates too much, like in South Africa, too segregated, I don't think it works that well. If it's the complete circuit, I think we've got a long time ahead of us with two worlds.
And I think one of the reasons South Africa's led the world in crypto adoption is precisely because of our predatory banks and terrible banking system. They've proven themselves to be inadequate at the task, and so crypto has been a very easy tool for South Africans to pick up and adopt. And so that's why some of the founders and most important people in the biggest crypto projects on earth right now are South African, is because we had the institutional failures to kind of get us going with. It's like electricity supply, you know, like I'm surprised we haven't come up with the next generation of renewables because we've had such a great job with our own electricity supply. So where the challenge comes, the technology solves it, and I think crypto is and blockchain is in a key place in South Africa where it's solving a problem that our governments are really not. Like we were talking about these crazy APYs on earnings, but all you need to do in South Africa is turn your money into a dollar stable coin and you're going to see unbelievable returns, 10x, you know, whatever. But like that's just because our currency isn't really managing itself properly. So in each of these situations, I would say treat crypto not as a different system, but as a buffer to the failures of the existing system, and those continual, perpetual failures until it collapses are being mitigated by this iterative approach in crypto that offers us a path to the solution, a path to the future that will always change in line with what the future is offering.
And Daniel, yeah, would you agree with that sentiment?
It's an interesting one because I think ideally we would all like to be in a decentralized world where we're responsible for our own finances and issues that come with it. But I do believe that sometimes it's easier for people socially to hold someone else accountable. But I do really hope that DeFi is able to make the financial system here a lot more transparent.
Yeah.
How are certain things moving? How do we minimize corruption? And by using things such as blockchain technology, we can suddenly see transactions being moved and who they're going to. Understanding who the end customer is and KYCs and AML checks for all finance companies and anyone in the fund industry are vital. So by able to implementing a technology stack that can make this more transparent and clear and knowing where your money is actually going is vital. But I don't see a full-on decentralized society yet, but I do see it as almost like if you look at Instagram and Facebook. This is a weird one, but stick with me. My dad doesn't know how to use Instagram and Facebook, but this is something I've grown up with. And my business partner has 3 young kids, and I'm of the opinion they'll be able to interact with blockchains a lot better than what most people can in our generation. And I think when that day comes, we'll start seeing a more decentralized world. But until then, I do think that we are still going to be needing central authorities to be doing checks.
Well, I'll be the first to admit that when I'm sending a large transaction on the blockchain, I don't know if you guys have felt this, but I get nervous. I check that key like 5 times. I maybe send a little bit first. Oh, it went through. Okay, now send the big amount. Whereas when you're on your banking app, you just go dip, 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 because you know that you can always reverse it if you maybe made that mistake.
It's almost like Ghostbusters. Who are you going to call?
Exactly.
Yeah.
And there is something reassuring of having that third party. Of course, they've got a lot of control, and there's been situations where it might have been abused. But I still think we like having our hand held, especially when it's a large financial transaction. But like you say, the next generation might be saying, well, hey, we've grown up with this. We know technology. And yeah, it's one of these things where I think DeFi is going to be maybe a generational thing that we might look back at, when we've got gray hair and saying, hey, this is, we were at the beginning.
We were there.
Stuff happened.
Well, the hand-holding is nice, but when you're losing 20% per transaction through the hand-holding, after 10 transactions, you start to say, hey, if I work out how to do this myself, I don't need to give the 20% away to a large banking institution to lend to someone else for predatory rates and then not give back to me. So in that situation, you just go, okay, I can do it myself. I don't need to worry about anything. And you can move billions of dollars for less than the cost of a sandwich, So, I mean, for me, that's the no-brainer and the big...
Well, that's a very important point. And in a place like Africa, where there's a lot of migrant labor, and parts of the family live in one country and they send value back to another country. To take 20%, I'm sorry to say, it's almost criminal, especially if you've got low earners. If you can do this at less than 1%, 0.1%, and it takes 10 seconds to clear, there's your solution.
Then it's one of the fastest drivers of economic growth in Africa.
Exactly.
Because that 30% is one of the biggest detractors from the huge economic movements with our migrants and our remittance corridors. You're right.
But it's also just choosing the right platform to use, which tokens, which protocols, which DAOs, because we have seen tokens values drop drastically and be extremely volatile. But there is a solution there that allows for more stable, I don't want to say stable tokens, but stable payment systems and value holders that allows these transactions. And I think from a transactional basis, that's where DeFi is going to be huge, especially on the unbanked, where there will no longer need it to be a bank.
And this is a great point, is that the risk often in DeFi doesn't come from utility, it comes from speculation. When someone's spending money on JPEGs, the price goes up and down, right? But when someone's using crypto to pay for their oranges and apples every day to eat, you don't want an asset that's all over the place. You want an asset that is the same price today as it is tomorrow. And that's really where the big split within Africa and the rest of the world comes in, is that we've been using crypto for utilitarian purposes in remittance and other ways since the beginning, right? The rest of the world's selling their JPEGs for all sorts of crazy money, and we're going, no, I'm sending money home to my family, they're sending it across to there, they're paying for this and that. That's real utility, and that's utility you don't see elsewhere in the world. So in that way, I'd say we're not just ahead of the game, we're about a decade ahead of the rest of the world in terms of using crypto for everyday purposes, and it's now up to us to kind of understand and have a bit of confidence in that and go like, actually we are world leaders in this, and we've got a different use case from the rest of the world.
And I mean, maybe, not sure how much time we have left. Maybe we can even take some questions from the audience. But from all three of you, how would you say is the best way for someone to get started in DeFi? Like, what is the basic step one that each person should do?
Well, step one is download the Opera crypto browser, available today on Android, iOS, Mac, and Windows. Mm-hmm. There's a non-custodial wallet built into it, and you can use it today without signing up for anything. Anyway, sorry, that's my little pitch. Done.
Daniel, what would be step two then?
Use the mini op. No, I'm joking. I'd say trying to do a transaction with your own hardware wallet or software wallet that you actually have to type in that very long transaction code and just interact with it once. Mm-hmm. Start simple. If you go back to basics. I'm not recommending buying Bitcoin or giving any investment advice, but just doing a transaction with a cryptocurrency to start from there, and then allowing yourself to then go into the deep dive of DeFi.
Mm-hmm. Yeah, make one small payment from someone who's never used it before. Get them onto an app. You're going to say Opera, I'm going to say Binance. These things are all interoperable. That's the big thing. I can make a Binance payment to you at Opera. That's the beauty of it. Make a small payment, make sure people get it. That's how we convince people. That's how we get them up the adoption curve.
And thanks to our recent integration with Binance Connect, you can now trade with Binance directly inside your Opera wallet. So, I mean, it's even better.
Well, I mean, this is the beautiful thing. When I started with crypto, I used something called Dogecoin. Mm-hmm. Because it was very low transaction fees compared to Bitcoin, and you had big amounts, you felt a bit, I was like a Dogecoin millionaire back when the price was nothing. But seeing that we're all punting our own companies, I'll also say, Polygon's a great one to also interact with because our fees are very, very low and we're very, very quick. So yes, I think make a few transactions.
My advice is to not use any software. Use your own hardware wallet. That's your keys. Mm-hmm. That would be my recommendation to start learning about it. Only because I don't have a software wallet from our company yet, but maybe one day.
Perfect. Well, guys, thank you so much. I'm not sure how much time we still have.
No, I'm right. Yeah, I'm enjoying it. Look at you.
Oh, there we are.
There we go.
I was looking for you on the side.
I've got this dude next to me who's got a question. Hey.
Yes.
Go for it.
Hi guys, I'd love to hear the panel's views on the risks presented by the migration to proof of stake and it being deemed a security, and that the majority of Ethereum are held within 5, including Binance wallets. So you've now got, you're now transacting potentially securities through the platform. What implications that will have for the DeFi scene as a whole?
Okay, I just want to, before you start, we literally have 4 minutes. I'm helping all of you out here. All right, go for it.
So since you mentioned Binance, I'll go first. I think it's public out there how much we've done and spent on security. And not only have we done all that.
He said securities, not security.
Sorry, just give him the mic back.
Yeah, sure.
Yeah, the SEC, the Securities Exemption Commission, declaring Ethereum a security under legal definition of what a security is when it's proof of stake, because you can earn yield and earn profit from a security. and then it's an unregistered security going through exchanges, so you now have to block and stop the trading of securities as not a securities exchange.
That is going to be a bit jurisdiction answer. So in the US, you will need to make sure that you apply, and we will make sure that we comply. And obviously, our platform there is separate. In the rest of the world, we will make sure that we comply with whatever that regulator asks of us. And if it's then classified as a security, that's what we'll go for. In South Africa, at the moment, crypto is classified as a financial asset. So that's the way we will treat it. And that will change when the regulator changes. We're not going to arbitrage from that.
Whatever jurisdiction you're in, you're going to have to see how they've classified it. Some regulators are moving quicker than others. And you're going to have to be more specific on certain areas and where you are as an investor. So if you're a US domiciled, Swiss domiciled, Mauritian domiciled, these are the questions you need to figure out, but that's going to be much more based on where you as an individual, as an investor, would be. Trying to ask it as an open-ended thing is just, it would be difficult to try and give you a direct answer with that.
I mean, you're right, the threat really does sit for that 80% of the crypto market that is EVM compatible, and now that those are termed as being US domiciled, it does create a potential problem, and we're seeing, well, I think, even lately, Tornado Cash transactions being turned down through the Ethereum blockchain, so there's definitely more centralization. There is the potential for a more central decision-making, but that's not from a 51% attack from outside anymore as much as institutional bodies sitting within the circle of trust. So it's still to be seen how that can be properly weighed up, but I understand the SEC's concerns for the shift in proof, but I think it needs to be proven in a court of law a long time before we can say categorically what the impact is on humans. Yeah.
I mean, one of the cool things is that Polygon is, already a proof of stake, and we've been operating, and the SEC hasn't, particularly come after us, but we can at least show that from a use case, proof of work to proof of stake, it's not maybe as scary or as regulatory, crazy as it might be, because we have these proof of stake tokens that have been operating in the regulatory guidelines. So of course, it's a concern, something we need to consider, but hopefully it's not going to be too much of a systemic risk to the ecosystem.
Yeah. All right, guys, thank you very much. Let's hear it for them. Thank you.